Alright, guys. So today we are going to proceed with our topic event after the reporting period. Alright. So this one is actually covered under MFRS 110. Right. Again, this is event after the reporting date. Mean that if the company reporting date, like for example, the year end is 1st of January 2025 until 31st of December 2025. This event is happened after this reporting period. After, not before, not during the year, but it is after the reporting period. Okay, so normally, if it is happen after the reporting period, it will affect the next year or next reporting period, so-called SOPI or SOCI. But now, is there any effect for the current year? All right. So what we are going to discuss on the MFRS 110. Okay. So again, the outcome of this topic is the recognition and measurement of the MFRS or 110 and estimate and apply professional judgment for initial recognition and measurement. Right. So from our previous topic, we learned about provision, estimate, contingent liability, and contingent asset. So now the provision and the estimate, which our contingent asset or contingent liability, that one is all our estimation. So if we get information that is more accurate during the next accounting period, does our estimation will affect it? So this is the situation that we are going to see under this topic in FARS 110. Right. So again, event after the reporting period can be adjusting event or can be non-adjusting event. If it is adjusting event, we need to adjust in our current year financial statement. If it is non-adjusting event, so we just need to disclose or we need to do a proposed dividend. Right? So again, event after the reporting period can also come to going concern affected. What does it mean by going concern affected? Going concern mean that either the company cannot proceed further or continue further. Right, going concern. We know the concept of going concern, right? Going concern is that the company can proceed for the coming year. But if the going concern status is affected, like for example, company seems like cannot proceed for the coming year, all company are go for bankruptcy or liquidation. So what is our adjustment for current year, right? So these are the things that we are going to see. And if it is going concern affected, you can see the flow are going to go to the adjusting, mean that it is an adjusting event. So it is either adjusting event or non-adjusting event, only two. Right. So first thing first, we see the definition. The MFRS 110 defines event after the reporting date as those events, both favorable or unfavorable, good or bad event that occur between the end of the reporting period and the date when the financial statement are authorized for issue. Right. So this is the flow, or this is the what we call as the gap. Okay. After the year end, but the financial statement is not yet authorized to issue to others. Okay. The board of director normally after the year end, there is a few months for the company to prepare the financial statement, the full financial statement. Few months, right? After it is prepared, then it will go to the board of director, and board of director will authorize to issue to outsiders. Outsiders mean that public, regardless of outsiders mean that the user of the financial statement. So between this gap, before it is published, before it is given to public, so any changes or any event that occur between this period, we still can adjust during our current year. So this is what we call an event after the reporting date. MFRS 110, event after reporting. Because if it is after published, we cannot do anything. If it is after published, because it is published already, we give to others already, we give to public already, so we cannot change. But if before we give to the public, we still can change all these the information, especially the one that we estimate on provision and everything. Okay, so this standard has identified two types of event, which is those events that provide further evidence of condition that exists at the end of the reporting period, which is this one we call as non-adjusting event, we need to adjust because we have further evidence of our estimation, especially our estimation of our provision. We estimate that, for example, we estimate that we are going to lose in a litigation case by 10,000. We estimate. But after the year end, but before it is authorized, we actually being penalized by 50,000, for example. So you see, we get the information that is more accurate compared to the previous estimation. So we make adjustment before because we know we have to pay 50,000. So adjustment we do just now, provision for only 10,000. So we do adjustment for this provision, we increase it to 50,000 because we know we have to pay 50,000 for the next year, for example. That one. Okay. Those are indicative of condition that arose after the end of the reporting period. Okay. This is what we call as non-adjusting event, but it is significant event. Indicative of condition. Like for example, something really matter, really critical or really significant happen to the company. Like for example, company have flood, for example, very big flood. It will not affect the previous year, but it will affect the future. So we need to disclose. But it is not an adjusting event. Nothing for us to do, right? Because it is the what happen in future. Happen after the reporting period. So it does not affect the estimation. But it is significant because public or the user need to know what actually the current condition of the company, right? So date when the financial statement are authorized for issue. What is this actually? The date on which financial statement are authorized for issue uh, depends on the management structure, statutory requirement, and procedure followed by each entity in preparing and finalizing the financial statement. Again, before it is issued to public, this one is authorized for issue, is issued to public. It of course it depends on the company policy itself. Okay, so the adjusting event. First, we look at adjusting event. Adjusting event affect the financial position and performance measurement. Because, for example, we are going to change the provision. Provision have expenses inside it. And because of the expenses, it's going to affect the net profit. And because of the net profit, the performance measure are going to affect it. Like, for example, when you do what the ratio, right? Ratio with net profit ratio, return on asset ratio, of course, is going to affect, right? Okay. Of the entity, even though they occur between the reporting date and the date of financial statement were authorized for issue. You see, because it affect our estimation. Okay. The accounting treatment is to adjust the element of financial statement affected by this event. Okay. So for example, this one is measurement of bad and doubtful debt. So you see, when you do the allowance for doubtful debt or provision for doubtful debt, you just estimate that maybe this person cannot pay their debt. But after the reporting that, you really sure that this person cannot pay. So what you do to the current financial statement, you adjust because you want to know the because the you have extra evidence of who actually cannot pay, right? Determining the net realizable value of the inventory. Okay, this is extra evidence of the value of your inventory. Court case, being sued or sued. The impairment of asset, like indication, any information or any indication of impairment. Cost of asset purchase or proceed from disposal of asset. This one is the information on asset. Profit sharing or bonus. And fraud case. Right. So non-adjusting event, okay, no adjustment are made, but the following disclosure should be provided. Like, even though we did not make any adjustment, and if we did not make any adjustment, definitely it will not affect our net profit. Right. But we should disclose. Disclose to where? To the notes to the accounts. Right. So what should we disclose? The nature of the event, and then the estimate of financial effect or statement that such an estimate cannot be made. Right. So these two is information on disclosure. Okay, for our level, no need for you to do the disclosure, right? You just need to inform that the disclosure need to be made, right? So example of non-adjusting event is decline in market value of investment after reporting date. A major business combination. You see, All these are significant effect that are going to have, affect future of the company progress. But no adjustment we need to make on the current year financial statement. Announcing a plan to discontinue the operation. You see, discontinue an operation, disposing an asset or etc. etc. Okay, major purchase and disposal of asset or expropriation of major asset by government. You see, all these are significant event, but it is non-adjusting because it will not affect our current estimation of provision. Will not affect because it's just information that's significant, very very significant information, but only for us to adjust any of our provision current year. So what we need to do is just disclose all the information inside notes to the account. Right. Next, disruption of major production of plant by fire after the balance sheet. You see, this one is natural disaster, right? Flood or fire, right? Effect in future, effect in the next period, but the effect is severe, significant. But the current year balance sheet or current year financial statement, net profit is not affected. So we just need to inform in the information or in the financial statement. Okay. Uh, this one is example of non-adjusting event. Again, okay, a major restructuring, major ordinary share transaction, changes in tax rate or tax law, entering into significant commitment or contingent liability, and commencing a major litigation arising solely out of event that occurred after the reporting date. If the event is occurred before the reporting date, we need to make adjustment. If the event happened after the reporting date, we just need to make a disclosure. Remember, remember in the previous chapter that we learned in FAR513, the provision. In order for us to make a provision, we need to have a present obligation. All of these don't have any present obligation. That's why no need for us to make adjustment on the previous one. But all of these events are significant enough, even though it is non-adjusting event, but it is significant. Therefore, we need to disclose inside the notes to the account. All right. Okay. So this is another situation which is for dividend and going concern. Okay. For dividend, should we make adjustment because dividend is normally announced after the year end, right? Because now company know what is the net profit. So if the net profit is good, then the company will announce the dividend, right? So dividend, should we make adjustment or not, right? Proposed dividend, again the word, proposed dividend are not present obligation, right? Not present obligation, and are not to be recognized and liability. Because it is not obligation, then it is not a liability. So, but announcement is made, and it is significant because dividend, right? Dividend is the sharing to shareholder. Shareholder is the owner of the firm, so it is significant. So, what should we do? We should just disclose. We should just disclose in the notes to the account. Right. So again, what if it is going concern status? Okay. If it is going concern status, where the management determine after reporting that it's intent to liquidate the entity or to cease trading, or that is no realistic alternative but to do so. Okay, then the going concern assumption used in preparing the financial statement may no longer be appropriate. So if the company intend to liquidate means that intend to close, cease, stop, and close. Okay, so going concern assumption used in preparing the financial statement may no longer be appropriate. What does it mean by this sentence actually? When you prepare a financial statement, you prepare based on going concern. When you prepare based on going concern, you do because you know next year you are going to have another balance sheet or another financial statement. So that's why end of the year you do a balance carry down because you know next year you are going to carry it down, right? But if the going concern status is no longer appropriate, then you cannot do this because it is not appropriate anymore. So you cannot transfer to the next year. No, it's not. You cannot transfer, but because the going concern assumption is no longer appropriate to use, therefore you cannot assume that next year you are going to have another beginning balance because there is no going concern. So the financial statement are to be prepared based on liquidation basis. So you need to prepare your financial statement based on liquidation basis. All right. Okay. So this is the situation. Okay, this is the opening period. This is the end, right? The end, the opening. Okay. So this is the board of director, BOD board of director, declare, publish, audited financial statement. So from this date to this date, this is the event after the reporting period, which cover under MFRS 110. Right. So this date to this date, in this situation is 3 months. In this situation is 3 months. Sir, is another is it possible to have until 5 months? Yes, possible. Depends. Remember, depends on the company policy. As long as it is not yet published, so it is still event after the reporting period. Normally, the company will try to publish the soonest possible because information, right? The financial statement is information about company, right? The information, the faster people get the information, the more reliable the information are. Right. The faster the timeliness concept, right? The faster you get the information, the better or the more reliable the information. Okay. Right. Next. Based on example given, between the soft pay date and published audited statement. Okay, between this 31st December 2014 and 31st March 2015. That is what being covered under MFRS 110. All right. Okay. So this is example of adjusting event. Right. So estimation of bad and doubtful debt. Right. So this example, a customer thought to be a good in financial year in 2014, thought to be a good. Okay. Later found to be bankrupt on 15 January 2015. You see, in 2014, we thought this customer can pay. Right. But suddenly, in 15 January 2015, suddenly out of nowhere, it go to bankrupt. The amount owed by the customer is 10,000. So this one is adjusting event or non-adjusting event. So the answer is adjusting event. Why? Because we have further evidence, which is the customer or the client is bankrupt, further evidence that show that this person or this account receivable unable to pay their debt. Because of this information, for the current year, we need to make estimation. Okay, company should make adjustment on its financial statement by decreasing 10,000 of account receivable and also decreasing the same amount in allowance for impairment of doubtful debt. You see, based on this information, the company are using this information, this extra information to make this adjustment. This is what we call as adjusting event. So we adjust the current year because we have further information or further evidence that this person unable to pay their debt. Okay. Right. So next example, net realizable value of inventory. So at the end of the year of 2015, okay, inventory were valued at 50,000. Okay, so this is the value of inventory at 50,000. However, 2 weeks later, okay, at the end of 2015, finished already 2015, but 2 weeks later, the inventory was sold only at 30,000. You see, if it is inventory, you need to keep value your inventory based on cost and net realizable value. See, remember this one, cost versus net realizable value. Okay, so net realizable value is the value that you realize. Realize means that the value that you can sell the inventory. So the cost are 50,000, but net realizable value is only 30,000. You should choose the lower of between these two. Okay, it was clear that inventory at 31st December 2015 were overvalued, right? Because you cannot sold at 50,000, even though the cost is 50,000, you can only sold at 30,000. So this is extra evidence or new evidence that show the value of your inventory is incorrect. Therefore, you need to adjusting event. So the company should make adjustment by increasing cost of sales by 20,000 and decrease the inventory value by 20,000. Okay, we debit our what cost of sale, we got this cost, and we credit our inventory, right? Okay. Next, hot case. Okay, related to action by customer related to the sales in year 2014, the amount could not be determined precisely. This one is 2014, the amount still cannot be determined precisely. Disclosure was made, only disclosure is made lah, in financial statement for the year end 31st December 2014. However, between 1st January and 31st March 2015, you see, this situation is an event after the reporting date, which is covered under FAR513. Okay. A settlement were reached and the amount of liability positively determined, which 5,000. You see, this extra evidence or new evidence show that now we can determine. Previously, it cannot be determined, but now show that we can determine. Therefore, because now with the new evidence we can determine, so we adjust. So the amount 5,000 we record as an expenses in softball, and the same amount should be recognized in soft P as a provision. So because now we can determine the amount, so the amount can be estimated reliably. Present obligation, yes, because it is a court case in 2014. You see, present obligation, the amount can be determined reliably. And in order for us to solve this, there is a resource outflow from the inventory. Three criteria of liability is recognized. So we make this record. So debit the expenses, which is support, and credit the estimation, which is provision for litigation case for liability. Okay, right. Next, fraud. Okay, during audit, a fraud related to year 2015 was discovered. Okay, the fraud was 2,000, was intentionally to increase profit by valuing inventory higher than reality. All right. So in this case, accounting treatment, this is adjusting event because it is a fraud. Okay, the company should charge 2,000 as expenses in softball, which is loss on misappropriation, and reduce the same amount in the inventory account. So if this is the case, we need to adjust and we need to, of course, this example is not it's not detailed or comprehensive example, but whatever we have here, we just record here. Okay. Okay, next. Working example event after the balance sheet date. All right. So two events were found by the auditors in the course of preparing the published financial statement. Okay. Number one, a debtors of 10,000 was found bankrupt on 20th January 2015, and a batch of inventory costing 20,000 were not counted in the closing stock as at 31st December 2014. All right. So you see, we assume that it is year end is 31st December 2014, and the bankruptcy happened. Additional information we get is 20th January 2015, which is after the reporting date, and this one is additional information also. We just find out that it is not count mistake. Mistake is go under the case of error. Okay. So in this case, okay, before the adjustment, you see, this is the preparation of balance sheet or soft P before adjustment. Okay, you see the effect on receivable. Receivable originally is 5,000. Inventory originally is 150,000. Okay, you see, when you want to record these two, it's found bankrupt. Okay, so what you do is both events are related to condition as this in 2014. So the effect of that failed bankruptcy is to reduce the allowance for double debt and the value. Okay, the effect of inventory unaccounted is to adjust the value of inventory and cost of goods sold. Okay, value of inventory and cost of goods sold. Okay, cost. Right. So therefore, you can see here. Okay, therefore you can see here. So the receivable is minus by 10,000 here because of this 40,000. Okay, and inventory is plus with 20,000 because it's not counted. Okay, right. So you see, previously 50, 150, now it is 40 and 170. Okay, all right. Okay. I hope for this part is no issue. But in order for us to make it balanced, right? In order for us to make it balanced, right? Also, what is the impact? In order for us to make it balanced, what is the impact on this part, right? Okay. So you see, uh, Okay. Receivable is minus by 10,000 by reducing the provision, right? So mean that under receivable, this one is net receivable. We know that net receivable is account receivable or trade receivable less with a provision for doubtful debt or allowance for doubtful debt. So that's why it is increasing by 10,000. Okay. So for us to increase the provision for doubtful debt by 10,000, what should we increase, guys? Okay. That 10,000 was found bankrupt, right? So what should we increase? Reduce effect that the file bankruptcy is to reduce the allowance for the value, right? So it will affect this one, right? It will affect this one, right? So you see, 10,000 is minus 1. So in order for us to minus extra provision, so what should we do? In order for us to minus extra provision, what should we do? Okay, mean that this one is actually the actual actual debt or actual bad debt, right? So therefore, in order for us to increase either way, right? Either way, you can increase the provision or you can just recognize this as a bad debt, actual bad debt, uh, by increasing the expenses. So increasing the expenses, you see, increasing the expenses will, you see, this one is originally is 80,000. So 80,000. Increasing the expenses will decreasing the retained profit by 10,000. And inventory is increasing because it is not recorded, right? It is not recorded. So we need to record, right? It is not recorded, right? Were not counted, right? Were not accounted, right? So adjust the value of inventory and cost of goods sold were not counted, right? So because it is not counted, so we are going to record as debit inventory and credit cost of sales. So cost of sales on credit side mean that this one is fall under gain, under revenue. So therefore we plus 20,000 here. You see, when you do this, then you get this figure, which is what we call as adjusting figure, and therefore it's balanced here. And therefore it is balanced here. So this one is the soft P under which is effect under the balance sheet. The effect must be balanced. Of course, must be balanced. The asset side and the equity and liability side. Okay. Right, I hope this one is okay. Okay. Example of non-adjusting event, but required disclosure. Right. So the business combination, discontinued operation, major acquisition or disposal of asset, expropriation of asset by government, destruction of some section of business by flood, natural disaster, and fire, and litigation case that is potentially damaging after the balance sheet date. All of these are significant event, but don't have any present obligation to the current year. That's why if don't have any present obligation, we cannot recognize the liability, right? We cannot recognize the provision because it don't have any present obligation, regardless whether it is a legal or it is constructive obligation, right? So example of non-adjusting event but required disclosure. Okay, but required disclosure. This one is continue. Entering into significant contract or securing a big contract, change in tax rate and provision, major transfer of share transactions, split share and bonus issue, and proposed dividend, right? So this one is all information, situation or example. Okay, that's it for this MFIs 110. I'll stop recording. Yeah, thank you.